You've probably heard of dozens of trading systems: smart money concepts, supply and demand, price action, volume analysis. But here's the truth. Every one of those methods is built upon the same foundation, the Wyckoff Method. That's right. Wyckoff isn't just another theory, it's the root logic behind how markets actually move. Yet most traders still find it confusing. Phases A, B, C, D, E. Strange terms like PSY, BC, AR, ST, UTAD. But here's the thing. It's not Wyckoff that's complicated. It's the way people learn it. Because Wyckoff isn't about memorizing labels. It's about understanding market behavior. So in this video, we'll break it down into two simple parts. 1. The story behind Wyckoff, the logic that drives every price move. And 2. How to apply it to a real example.
Part 1. The story behind the Wyckoff Method. Richard D. Wyckoff was a Wall Street pioneer from the early 1900s. He wasn't just a trader, he was an observer. He studied how the biggest market players, what he called the composite man, operated behind the scenes. His key insight was simple but revolutionary. Price doesn't move randomly. It moves because of the deliberate actions of large players. But the truth is, even the biggest players face their own set of challenges. In fact, their size often becomes their biggest disadvantage. Let's put this into perspective. When a large institution, say a hedge fund or mutual fund, wants to buy shares of a stock, they're not buying 1,000 or even 10,000 shares. They might be looking to accumulate millions of shares. But here's the catch. Every market has limited liquidity. At any given price level, there's only so much supply available. If they rush in and start buying aggressively, their own buying pressure pushes the price higher, making every next share more expensive. The more they buy, the worse their average cost becomes. The same problem exists on the sell side. When institutions want to unload their position, they can't just dump millions of shares all at once. That would flood the market with supply, crush the price, and destroy their own profits. The market simply can't absorb that kind of volume in a single session or even a few days. So they need a strategy, a way to enter or exit quietly without revealing their intentions. This brings us to the second challenge: stealth. If the crowd figures out what the big players are doing, everything falls apart. When retail traders notice unusual volume or strong momentum, they often jump in, hoping to ride the wave. That sudden attention can ruin the big players' plan, either driving prices up too early during accumulation or accelerating the drop during distribution. Once the crowd knows, the edge disappears. So how do institutions solve this? They operate with patience and precision. They break their orders into smaller pieces, executed over days, weeks, or even months. They'll buy on weakness and sell on strength, making their actions look like ordinary market activity. They use volatility to their advantage, shaking out weak hands and filling their positions at favorable prices. This invisible tug-of-war between accumulation and distribution is what creates the market structure we see every day. And that's exactly what Wyckoff observed more than a century ago. He realized that behind every sideways consolidation, every breakout, and every crash, there's an underlying story of big money positioning itself. From this observation, Wyckoff outlined 4 repeating stages of the market cycle. 1. Accumulation. Smart money quietly buys when the crowd is fearful. 2. Markup. Prices rise as institutions drive the move. 3. Distribution. Big players sell to the public during the height of optimism. 4. Markdown. Prices fall as the crowd panics and sells in fear. These 4 phases repeat endlessly on daily, weekly, and even intraday charts. Wyckoff's goal was never to fight these giants. That would be impossible. His purpose was to study their footprints through price and volume, to recognize when they're buying, when they're selling, and when the market is simply resting. Because once you learn to see what the big players are doing, you no longer trade against them, you trade with them.
Richard Wyckoff distilled all of market behavior into just 3 timeless laws, simple in words but profound in meaning. They explain why prices move, how trends form, and when they begin to shift. The first law is the law of supply and demand, the foundation of every market. When demand exceeds supply, prices rise. When supply overpowers demand, prices fall. And when they balance, the market moves sideways, a period of consolidation or distribution. It's in these quiet phases that professionals are often most active, positioning for the next big move while the public loses interest. The second law is the law of cause and effect. Nothing in the market happens without preparation. A powerful uptrend doesn't appear out of nowhere. It's the effect of an earlier cause, a long accumulation phase. Likewise, a sharp sell-off is often the result of weeks or months of distribution. The size of the cause determines the size of the effect. The third law is the law of effort versus result. Volume is effort. Price movement is result. When high volume leads to strong price movement, the trend is healthy. When big volume produces little movement, it signals absorption. Someone is quietly taking the other side. And when price moves sharply on weak volume, it shows a lack of confirmation, a warning that momentum may soon fade. Together, these 3 laws allow traders to see the footprints of institutional money and understand the hidden logic driving every chart.
By this point, you've seen the logic behind Wyckoff's ideas, the laws of supply and demand, cause and effect, effort and result. But theory alone isn't enough. Wyckoff went one step further and broke down how accumulation actually unfolds on a price chart, step by step, in 5 distinct phases. Phase A is where the downtrend finally loses strength. Selling pressure starts to dry up, volume decreases, and prices stop making new lows. This is the first hint that demand is quietly returning. Phase B is the building phase. Here, the market moves sideways as the composite man, Wyckoff's metaphor for institutional money, quietly absorbs supply. To the public, it looks boring or uncertain, but this is where the groundwork for the next big move is being laid. Phase C is the spring, the final shakeout. Price briefly breaks below support to trigger stop losses and scare out weak holders. But instead of continuing lower, it snaps back quickly, a clear sign that strong hands are in control.
Phase D is the confirmation. Demand dominates, price breaks through resistance, and pullbacks are shallow, showing that sellers are nearly exhausted. Phase E is when the trend becomes obvious. The uptrend begins, volume expands, and the public finally joins in, usually late. In reality, it's rare to see a pattern that perfectly mirrors the Wyckoff model. It isn't meant to be memorized, it's meant to be understood. Because when you grasp the story behind each phase, you're no longer reacting to noise, you're reading the market's true intentions. Part 2, Applying Wyckoff to Real Charts. Nvidia Case Study. From January to June 2024, Nvidia was in a clear uptrend. Each higher low signaled consistent buying pressure and rising demand. After that strong run, the stock entered a consolidation phase that closely mirrored Wyckoff's accumulation structure.
During this phase, buyers made several attempts to push the stock higher, but every rally failed. Each time price tried to break out, sellers stepped in quickly, forcing it back into the range. This behavior revealed that supply was still in control. The market wasn't ready for a sustainable move yet. These failed breakouts weren't random. They were part of the natural testing process as institutional players assessed how much supply remained in the market. Then, in April 2025, something important happened. Nvidia dipped below the bottom of its accumulation range, a false breakdown, or what Wyckoff called a spring. Many traders mistook this as the start of a new downtrend. But instead of continuing lower, the stock quickly rebounded with strength, showing that sellers had been exhausted. That move marked the final shakeout, the last attempt by weak holders to exit before demand fully took over. Once buyers regained full control, the price surged and broke out above the consolidation zone. This time, the breakout was far more reliable than the previous false moves, and here's why. 1. The prior rally showed strong momentum, and 2. The base before the breakout had tightened significantly with low volume, signaling that selling pressure had dried up and buyers were firmly in control. Following that breakout, Nvidia went on to climb another 40% at its peak.
Key takeaways. Wyckoff is an excellent framework for understanding how the market works, but I wouldn't recommend applying its theories wholesale when searching for investment opportunities, as the method has several limitations. First, it's not beginner-friendly. Learning Wyckoff is like learning to read the market's language. It takes time, repetition, and intuition. You can't master it in a few weeks. You have to study hundreds of charts, take notes, compare structures, and backtest until you start to feel the rhythm of accumulation and distribution. Second, it's highly subjective. Two traders can look at the same chart and tell completely different stories. One might call it a spring, another says, not yet phase C. Interpretation varies, and that's both the beauty and the danger of Wyckoff.
Third, even with detailed volume and price action analysis, identifying where accumulation ends and distribution begins is never easy. The market doesn't label its phases for you. And finally, Wyckoff doesn't give you exact trading signals. It shows the market structure, not the entry, stop-loss, or take-profit levels. That's why professional traders often combine it with tools like price action or volume profile to refine timing and risk. In the end, Wyckoff isn't about memorizing patterns. It's about understanding how smart money moves and learning to move with them.
If you've stayed with me until this point, then I have something for you. Something that, in the right hands, is worth millions, and I'm not exaggerating. Years ago, I used to teach traders face-to-face, real sessions, real charts, real trades. We sat in the same room, looked at the same markets, discussed every candle, every volume spike, every failed breakout, and every moment of hesitation that separates amateurs from professionals. These weren't theoretical classes. They were live, practical, raw trading sessions. And the tuition for those classes? A few $1,000s per student. It wasn't cheap, and it wasn't meant to be, because the traders who joined weren't looking for easy tricks. They were ready to commit, ready to study, and ready to put in the work. And the results spoke for themselves. Right now, on the screen, you're seeing some of those early students, the same people who once sat exactly where you are today, curious, uncertain, searching for a real edge. Not all of them became millionaires. That was never the point. But many reached something far more important: consistency.
They moved from guessing to understanding, from hoping to executing. Some of them now trade full-time. A few even manage capital professionally for funds and institutions. But most simply reach the stage every retail trader dreams of. The stage where trading stops being chaos and starts becoming a real business. And here's the good news. Today, you don't have to pay thousands of dollars to access the same principles I taught them. I'm giving you all of those foundational lessons, the mindset, the frameworks, the execution principles, almost for free. All I ask is a symbolic $25 commitment fee through YouTube members. Not $2,500, not even $250, just $25, roughly 1% of what earlier students paid to learn the exact same concepts. And in case you're wondering, after YouTube takes its 30% cut and taxes take another 30%, I barely receive anything from it. This isn't about the money. If I wanted to charge thousands again, I could, and people would pay because they already have. This is about something else entirely: commitment.
Everything that's free is ignored. I've seen it 100 times. People download free PDFs, free strategies, free checklists, and they never open them. They never apply them. They never value what costs them nothing. So that $25 isn't a price, it's a filter. It tells me you're serious. And more importantly, it tells you that you're serious. Think about it for a second. 25 bucks, roughly what you'd spend on a couple of Starbucks drinks, in exchange for a trading framework that can actually help you make money in the market and save you years of frustration. Not to mention potentially hundreds of thousands of dollars in avoidable losses. You're not buying content. You're buying clarity. You're buying a shorter path. You're buying access to a mindset and method that traders before you paid thousands to learn and used to transform their trading. I've already opened the door. Now there's only one question left. Are you willing to trade a few cups of coffee for the chance to completely change your trading career?